Do we need more office space right now in Denver?
No.
We don't. But is there more office space now than there was in 1986?
Of course.
Absolutely. It's probably doubled or tripled since I moved here. So what does that mean? That means that even though the market was in really bad shape back in 87, 88, and there were hundreds of thousands of square feet of vacant office space, the people that took action and bought it up because they saw the pendulum. There's all kinds of pendulums when it comes to different investing. Right now, the office market pendulum is way off to one side. Well, eventually what it's going to do is it is going to swing back.
What's up, Colorado? Chris Lopez here, and I am extra excited about my guest in the podcast studio today, Mr. Anthony Chara. I have known of Anthony for years of being around Denver for two reasons. One, a very successful multifamily investor and syndicator. And secondly, he has helped so many people in their education and their success. And what I found so unique, besides he's been investing for 30 years, is that every person I've talked to who's gone through one of his classes or his apartment mentorship program, they've all had wonderful things to say about Anthony and what he's taught, which is very rare in the real estate guru space. And I was very fortunate at a iCore event recently. I got to sit down with Anthony for a bit, meet you, and then get you in the studio. Anthony, welcome.
Thanks for having me, Chris.
So I know some people know you, some don't. Can you give us a little background on just where you started and then where we are today? Because I want to talk a lot about the market today, but let's start with where you are because you've been through some market cycles.
Absolutely. Yeah, I've been through a couple of them. So my wife and I started investing back in 1993, so quite a while ago. We started with single family homes because that's all we knew. We thought real estate investing was going out, buying a single family home, turning it into a rental. Then you went out and bought another one and turned it into a rental. And that worked pretty well. But then after 10 years and about 10 properties, I got to the point where I was tired of doing onesies at a time and was looking to get to the next level, trying to buy something a little bit bigger. Well, I went to a business opportunity meeting, and there were a few people sitting around. This gentleman had invited us because he wanted us to invest in this opportunity. And one of the people that was sitting there said that he had owned 450 apartment units. And I was thinking, well, this is great because I want to get to the next level. This is a guy I probably want to talk to. And the reason I found that out is because we all went around and introduced ourselves. And so after the meeting was over, I asked him if I could take him to lunch. He said, sure. So we sat down for about an hour and a half or 2 hours and talked about apartments and how long he'd been doing it. And he'd been doing it at that time over 40 years. And that was back in the early 2000s. And he started out just doing duplexes, triplexes, fourplexes in Wichita. Then he moved him and his family to Denver. And he only owned, I think it was like 5 or 6, maybe 7 complexes in the 450 units total. But what really hooked me about this particular guy in apartments was that he was telling me that in his heyday, which was about the mid 90s, he was making $140,000 to $150,000 in passive income every month.
Woohoo. I mean, that's a lot now. That's a lot back then.
That was a super a lot back then. And it's like I said, it's even a lot today. I'd be okay with $140,000 to $150,000 in passive income every single month. So I wanted to learn more from him, and I did. And then went out and started learning from other people, met my original first partner, George Antone, and we started going out and buying apartment buildings. We also realized that based on how our properties were going, that there were some gaps in the information that we were getting from the other people that we had learned to buy apartments from. And it seemed like they were just skimming the surface. And once you actually got into buying the apartments, all of a sudden it's like, holy cow, we missed this, we missed that. And decided at that point in the mid 2000s, about 2006, we started actually teaching other people based on our experiences and what we had learned, not only positively, but what we had learned negatively with some of the different deals that we had done. So I got into apartments just because I wanted to up my game and go to that next level, and then got into teaching because quite frankly, at the time, one of our other mentors was a gentleman named Robert Allen, and Robert Allen wrote a book called Multiple Streams of Income, which you have on your shelf behind you.
That was one of the key reasons I got into real estate.
Yeah. And so what we realized is it wasn't just about investing in real estate. It was how could we teach other people and bring that in as another stream of income because there were a lot of people teaching. And this was in the mid 2000s when literally somebody could stand up on stage and say, hey, I could teach you how to pick your nose for $5,000. And half the room would jump up and run to the back of the room and buy their program. And it's like, okay, we could do that too. And we think that we can come up with a better product because we've been through some of these other classes and there's so much stuff that was missing based on our experience and the mistakes that we had made because we weren't taught exactly what to look for. So it's kind of gone from there. And now I continue to teach people just because I love, number one, I love teaching people. Number two, I love traveling around the country and around the world doing the different classes that I do. So, and my wife, the good part about it is my wife loves traveling as well. So we've been all around the globe teaching classes and seeing the world. And it's a great way to combine a business trip and write it off as a business expense and see the world and teach other people how to be successful.
Yeah. Side note here, when I was looking at your website a while back, I saw one of the retreats was like a 7-day sailing trip in Fiji, or was that where it was? Like that's not a bad place to go spend a week in multifamily boot camp or whatever it is.
It's a great way to take a business trip and write something off of your bucket list. So we've done what we call our catamaran training events. We've done those anywhere from the Caribbean down to Fiji. We've done 2 in Fiji. We've got another one coming up in March of 2025. It's 7 days on a catamaran floating around gorgeous water, and there's scuba diving and snorkeling and great food, and it's all taken care of on the boat. You even sleep on the boat for a week. And we are able to write it off as a business trip because of the way that we conduct classes on the boat. We make sure that we have classes. It's not my full 4-day boot camp. You can't do that on the boat because nobody's going to sit around and listen for that long. But we do enough training each day on the boat to qualify for an IRS discount, and it's our meeting space. Yeah. So it's a fantastic way for people to learn and have fun at the same time.
I love it. So I think you have done over 1,800 apartment units that you've owned or syndicated. Is that correct?
We're actually over 2,100 units.
Even better.
So, yeah.
Well, congratulations.
Thank you.
Now, what I'm really curious to dive into is you're 30 plus years into this, and we are going through a market correction, maybe a market crash in commercial right now, but you have been through a few different market cycles. My 2 parts of this question is like, how do you approach a big market change? Like, what's the right attitude for defense and offense? And then second, how does this compare to other market corrections? And I'll let you answer whichever one you went first, but I am just dying to hear you speak on this.
Sure. So it's kind of interesting because each correction, as you put it, has been unique. So back in the late 2000s, between 2006 and 2009, it was really the single family home market that crashed. Mm-hmm. That crashed partially because a lot of people panicked and freaked out when the market started to slow down. A lot of people just said, hey, I bought my property for $200,000, but the one across the street just sold for $100,000. So why am I going to keep paying a $200,000 mortgage on a property that just sold for $100,000 because it was foreclosed on and somebody came in and bought it out of foreclosure for half price? So a lot of people then just stopped paying mortgages and it got worse. And even though the single family home market was doing poorly, our apartments actually were doing great. So everybody else that was panicking and seeing the single family home values drop, our apartments were continuing to go up in value because they're purchased based on a completely different formula, where single family homes are purchased based off of comparables. Mm-hmm. The house across the street, cookie cutter house, 3-bedroom, 2-bathroom, 1,800 square feet, sold for $100,000. And the one next to it sold for $100,000. The one next to it sold for $100,000. It doesn't matter if a year ago you bought yours for $200,000. If somebody comes in and wants to buy your house, it's now only worth $100,000 because of all these comparables in the market. With apartments and other types of commercial property, what you're really buying is a stream of income. And as long as you can keep that stream of income going up, people are willing to pay to get their hands on that stream of income. Now, that does kind of dovetail into what's happening right now with the market with interest rates. So right now, even single family homes in a lot of areas around the country, like right here in Denver, and I've got properties all across the country, and I get my little reports that pop up every week or month on Zillow, and it's still showing all my property values are going up. So there are some areas that are going down, but a lot of areas are still going up when it comes to single family homes. However, on the flip side of that, with apartments and commercial property, since you're buying a stream of income, that stream of income and the value of the property is also tied to interest rates. And with interest rates pretty much doubling over the last year, a lot of sellers have not, still think that they're back in 2022. They still think they can command these high dollar amounts for their apartment complexes. And quite frankly, some of them are still getting it because there is still a need for housing in the country. Not every single market, but we're something like 1 million housing units behind where we need to be.
Mm-hmm.
And that's not even including all the immigrants that have been flooding into the country over the last couple of years. So just the people that have been here before that, we were like 1 million homes behind, or well, I shouldn't say homes, 1 million units behind. That includes apartments, houses, condos, things like that, even mobile homes. So there are areas around that are still struggling. So values, even for apartments, are going to continue to stay high. But there are some areas like Dallas where they've been overbuilding. And matter of fact, the last article I read was they were expecting an additional 50,000 apartment units in Dallas this year.
To come online?
To come online this year. And that's just Dallas. That's not Dallas-Fort Worth. That's just the city of Dallas. And when you look at Dallas, Fort Worth, and everything in between, Arlington, Irving, and a few other markets, that's a lot of units. And because you're buying that stream of income and interest rates have doubled, people need to pay less for the property in order to get the same returns that they were getting back in 2022. So some sellers understand that, and they have been dropping their prices anywhere from 10 to 15%. Some don't get it or don't care. And so they have a decision to make. They come out and they put their property on the market. And if it sits there too long, then they've got a decision to make. They can either drop their price and leave it on the market, or they can just refinance the property and keep it for another 5 or 10 years. Now, what they're going to realize, though, when they do refinance it, is that their payments are going to be higher because interest rates have doubled from when they took out their loans 5 to 10 years ago. But they're still in a position where they don't necessarily have to panic and sell as long as they've been running it correctly over the last 5 years. It's probably gone up significantly in value. And if all they're going to do is what's called a rate and term lock, where they're not really taking any additional money out, they're just refinancing the current balance on the mortgage that they have today, they'll be just fine holding on to the property for another 5 or 10 years.
But aren't a lot of those having to do like a cash in refinance?
Well,
I guess if they're bought more recently.
Yeah. So typically if they've been bought within the last year or two, a lot of those owners are doing cash in, and they're not refinancing them at all because they can't refinance them until they put cash in. All right. So what happened is that there were warning signs all over the place. And that's one of the reasons that I belong to other groups, because one of the things that you've probably heard, and I don't know if they talk about it in multiple streams of income, but I do know that Robert Allen was one of the big people that taught me this 20 some years ago, was that if you're the smartest person in the room, you're in the wrong room.
Yes.
Assuming that you're trying to learn something. Now, obviously if I'm hopefully up on stage teaching people something, I would hope I'm the smartest person in the room. But even if I'm not, I'll even tell people in the audience, hey, if something that I say doesn't jive with what you know, I encourage them to speak up.
Yeah.
Because I'm not up on everything, and I admit that. And I even tell them it's like mortgage rates. Mortgage rates change all the time, and mortgage programs change all the time. So I'm going to tell them based on what I know today, but if they know something different, raise their hand, speak up, let everybody else know, because I don't want people to think that I'm standing up here and I'm this all being guru that has all the answers. I've got a lot of them, but I don't necessarily have all of them. So I belong to these other groups that have other people that are smarter than me in them, because I want to learn from them. Even though I've been doing this for 30 years, my focus has been on the actual real estate investing. There are other people that understand financial markets much better than I do. And one of the things that they warned us about was that because of what they saw the federal government doing, like printing money like crazy because of COVID and doing the PPP loans and the what do they call it? The stimulus checks and all that kind of stuff. They're looking at this going, well, money's got to come from somewhere, right? They tell people to go home and stay home from their work for 3 to 6 months. and nothing happens for 3 to 6 months, something's going to come crashing down. And sure enough, they saw that inflation was going to go through the roof. And as part of inflation going through the roof, interest rates have to go up as well. So some of these other people that had bought recently within the last year or two, they had underwritten their deals as if their current loan that they had was going to stay the same interest rate, and their takeout loan was going to stay the same interest rate. So they were getting into what are called bridge loans. These bridge loans bridge them from the time they purchase the property until they refinance it a year or 2 or 3 years later. And generally it's a value add property where they're going to go in, they're going to put in extra money, they're going to fix it up. And because they fix it up, they're going to raise the rents $100, $200, $300 per unit per month.
Yeah.
That's a huge return. And of course, on paper, you're looking at the value of the property that they bought for $5 million, and in 2 years is now worth $10 million. So the idea is that within 2 to 3 years, now the value's gone up, they go out and they refinance the property. They get their investors all or most of their money back, and then they go find another property and start the whole process all over again. And those investors are eager to follow along with them because then they just got this huge payday back in their pocket. They now take that money and go invest in the next deal. And these guys just kept rolling that. Well, that worked great for 10 years. But over the last 2 to 3 years, what happened is they just thought it was going to continue to roll, even though the warning signs were there with inflation and interest rates going up. And their bridge loans, which are adjustable rate mortgages that in some cases adjust every single month, not just once a year or every 6 months, they might adjust every month. All of a sudden, they jumped through the roof. They went from typically they were underwriting around a 6% bridge loan, 6 to 7% bridge loan, and about 4 to 4.5% takeout financing in 2 to 3 years into the future. Mm-hmm. Well, all of a sudden, their bridge loans jump to like 9 or 10%. Their takeout financing, which they thought was going to be 4 to 4.5, is now at 7 or 8%. And bridge loans, quite frankly, bridge loans went up even higher. So when they first started going up, they jumped to like 9-ish, 8, 9, 10%. Now I've heard that they're between 10 and 13% for these bridge loans. So what's happened is a lot of that extra money that they raised from their investors, instead of going into the property to fix up the property so they could raise the rents, is now going to the bridge lender to keep the mortgage current. They have no money left to finish the project. So you were talking about doing a cash in refinance. They need to bring in a lot more cash to be able to refinance it because their LTV is no longer being met. They're not going to get that $10 million price tag like they thought they were because the cost of the money that they or their new buyer, so if they refinance it, right, the money's not there. Even though the income has gone up, because it's going to cost them so much more to finance it, the numbers just don't work. So now they have to bring more money to the table to make sure they have that full LTV, the loan to value gap in there. Generally, a lender's going to want to see a 25 or 30% down payment, which means the LTV is only going to be 70 to 75%. Well, those numbers worked great until interest rates went up. And now all of a sudden they're at like a 50% LTV, where they have to come in with 50% down payment because the value of the property did not go up as high as they thought it was going to go up as soon as they thought it was going to go up.
So that was a great and simple explanation on like the macro. So how can an investor view this? Because I see two different types of mindsets out there. You know, one is a lot of, syndications, a lot of multifamily stuff has a negative sentiment out there from people who bought the last couple of years, 2020, 21, 22, top of the market, rates go up, not to mention insurance and taxes. And now people are getting their distributions paused, capital calls, sometimes just being wiped out. So a lot of, fear and unpleasantness there. The other side of the coin, and this is the camp I'm in, is like, holy smokes, there's a lot of opportunity out there now to go out there and buy, but it's a very scary time. So like, what's your view on the sentiment and how can an investor kind of navigate the current market?
Yeah. Well, I think the biggest opportunity right now, there's actually two big opportunities. One of the opportunities, if you're interested in buying apartments and multifamily, is looking at smaller properties.
Define smaller.
6 to 10 to 20-ish units, okay. 30 units, like basically a mom and pop owned property. Why? Because some of them may be willing to do owner financing. So that helps you out tremendously there if they're willing to do it for a couple of reasons. Even if they're not willing to lower their interest rate, you don't have to go through all the hoops and jump over all the barrels and everything else that you have to do with a bank if they're willing to do a majority of the financing. That's number one. Number two, some of them will actually lower their interest rate. So they don't have to be like a bank and get 7 or 8%. Some of them might be willing to do it for 4 or 5%. And the reason they're willing to do it in some cases is just because A, they may not even know better, or B, because especially if you're a newbie and you come along and say, hey, I'm a newbie and I'm looking to buy my first property, sometimes they will have that sentiment in their heart that says, oh, well, I remember when I was a newbie and I was buying my first property. Sure, we'll be more than happy to help you out. We like you. We want to help you get on your feet.
Yeah, you pull on the heartstrings a little bit.
Exactly. Because you're dealing with a human being as opposed to a big REIT or an LLC that's a corporation, where investors are like, well, we don't care. Here's the value of the property. Pay it or don't pay it.
Yeah, here's a spreadsheet.
Right. So here's the numbers. Make us an offer. And they don't care about any of that stuff. And quite frankly, some of them, even though some of the owners may be okay doing financing, they also understand that they have investors to answer to. And a lot of those investors just want their money and they want to go on their way. They don't want to be waiting for payments to come in. And so that really sets things back. The other opportunity is on those larger properties, just like we talked about, Chris, is the owners that are in trouble, the owners that bought their properties 1, 2, 3 years ago, right before interest rates went up, and now they don't have the cash to continue to maintain that property. I know a couple of people that, quite frankly, they're in that situation. They're talking about, we generally have raised anywhere from $300,000 to $2 million to buy properties.
Like per deal?
Per deal, yeah,
okay.
Per deal. Our biggest one was $4 million. That was one of the hotels. We bought 34 units at a hotel down in Belize. We raised $4 million in cash. And we did it pretty quickly. We did it, and there was no leverage involved anyway. That's one of the reasons we needed all the cash, because when you're trying to get a loan in a foreign country, it's not like here. They're more like hard money loans down there, 50 cents on the dollar, 10. Back then it was 10% interest when you could get a loan here for 4. Ooh. So imagine what the interest is now when it was at 10 at 50% financing. So we had investors that jumped on that one pretty quickly. But for our regular apartment investments, we've done anywhere from like $300,000 to $2 million. And that was the down payment and closing costs. Well, now one of the people I know that's in one of these other mentoring groups that I'm in, they just did a $2 million cash call to keep the deal. And I don't know if he was successful doing it or not. I know that he was having some issues with one or more of his partners because they weren't doing what they were supposed to do. There was either 3 or 4 GPs, and he and at least one of the other guys were out, banging the bushes, beating the bushes and knocking on doors and trying to get their investors to cough up a little bit more money so they don't lose the property. And 1 or 2 of the other guys were just kind of like sitting there twiddling their thumbs like, well, you guys better get going and go raise some money. And they're like, well, what are you doing? And so that was one of the big things that they ran into, was with their partnership. So, but the opportunity for investors today is finding some of these deals that are upside down. And what you can do if you find the right deal, and they are out there, is you create a new group to come in. You basically come in as the hero, the rescuer, the savior, however you want to label yourself, but you write up the agreement in a way where you and your investors get paid first to help the original group save their deal and save some or all of their equity. So you come in, as I mentioned earlier, right? They have all this money that was set aside for doing rehab. Well, now that's all gone to pay the mortgage payments, and there's nothing left over to finish the rehab. So as long as you look at it and the numbers work, you come in with your group to help them finish that rehab cost. But the way the agreement is written up is when the returns come in, you and your group get paid first, and you get paid first up to X level. Then anything above and beyond X level can either be split, or you guys then just back out and then they take their deal back and away they go. And so, when I brought this up to other people, I said, well, why would an ownership group that currently owns it want to do that in that particular situation? And it's like, well, their choices are either save their principal, lose a little bit of their principal, or if they say no to both of those avenues, lose all of it.
Yeah. Because getting wiped out's not the best option.
No, because the banks don't care. The banks are going to say, we want our money back. And if you don't pay us, we're going to foreclose. And then we're going to just sell the property as quickly as we can and get whatever we can for it. And there's been a lot of that going on. There's been tens of thousands of apartment units that have been foreclosed in the last year or two for that exact same reason. There were ownership groups that ran out of money and they didn't have the money to continue to maintain the properties, and they ended up losing them. Matter of fact, one guy, this even made the Wall Street Journal about a year ago, or just under a year ago, lost 3,200 units and about $60 million. I don't remember if the 60 million was investor money or the amount of the value of the properties, but that's a lot of money.
Yes, I think I know which article you're talking about. There's been a few, unfortunately.
Yes.
So what are you doing with your capital, and what opportunities are you looking for right now in Q2 2024?
Well, we're still actually looking for apartment complexes. Yeah. We're still evaluating deals. There's a lower supply coming on the market. And I think part of that is because some owners have realized that they're probably not going to be able to get the prices that they want. So my guess is they're probably quietly refinancing them and just holding on to them for another 5 or 10 years. And then they'll take another look at the market in 5 or 10 years and sell. Especially if the property's still doing well, still cash flowing pretty well, they're going to be okay. There are some owners, we are looking for those opportunities that I just mentioned, those ownership groups that are in trouble. We actually have a mortgage broker down in Texas that can give us a list of property owners that he knows are in trouble. And so we're reaching out to those owners to see if they might be interested in partnering. And not every deal will work. There's probably only about maybe about 10 to 20% of them that will work based on the numbers that we're seeing. So that also narrows the pool. What else are we doing? We're also...
So, can I ask a question on that?
Absolutely.
Is a lot of your deal sourcing, do you do a lot of like direct to seller, or is it through brokers, or just both, or all sources?
I've got about 10 different ways that I source deals. So some of it is coming through direct marketing. Some of it is coming through brokers. We create relationships with brokers in the markets where we want to buy and let them know what we're looking for so they can go out and find it for us. Some of it is coming through talking to property managers. Especially if we go into a market, we start asking them or looking at a particular property and interviewing them because we're looking for a manager to manage it. We'll ask them, hey, do you have any other owners that have these types of properties? And we can make offers through the property managers as well. So there's a bunch of different ways that you can find deals. So of course, right now we are looking for those opportunities where the owners are upside down. Okay. We're still going out and looking at live deals that are on the market through some of the sources what I just talked about that brokers that we've created relationships with send to us. Some of those look good. And quite frankly, we'd love to buy them, but the owners are still unrealistic because they haven't had that reality set in where they don't understand that interest rates have gone up and money to us is more expensive than what they're currently.
Well, they're at 2021 prices still, right?
Yes, or 2022 prices.
20,
yeah. Because you could get a loan at 4% or 3.5%, quite frankly. And so now it's at 7 or 8%. Actually, they've come down. I just looked at a report this morning, as a matter of fact, and the high end from one of my brokers is like 6.6%. So interest rates are coming down, which is great. It's going to make property values probably sustain. So owners are a little bit less motivated. So we are still looking for apartments, but we're also diversifying too. I mentioned we own the part of a hotel down in Belize. We have an agricultural investment down in Paraguay. We're looking for commercial type endeavors that will continue that stream of income and also give us diversification of product and diversification of location. So one of the other things we did about a year ago is we did what I would call a minor pivot. And I partnered up with a couple of gentlemen who have been doing short-term rentals for over 5 years. And they have a proven track record that they've successfully done it. They've got it's like 12 units in 2 or 3 different markets. And so I found out that they were getting ready to do a syndication. They were going to raise money because they wanted to buy more properties. And so I approached them and said, hey, I'm good at raising money. I've got investors that are looking for stuff. We've been looking for apartments, haven't been able to find things. Do you want to partner up? And we had a conversation and we ended up partnering up. About 3 months later, after we opened up, we actually added on another gentleman who worked for Airbnb directly. He was one of their employees for 5 years. So he has actual Airbnb experience from the inside, which is also a great thing that we did. So we've raised over, I think it was over $1.5 million. We bought a bunch of properties down in Memphis. So we're looking at that short-term, mid-term rental fund area. We're also looking for a luxury property now. And we're about to close that fund out. And the luxury property, we're targeting an area called Sandbridge, Virginia, which is just south of Virginia Beach. And one of the reasons we like the area is because it's Airbnb friendly. So they don't have a lot of the regulations that they do actually in Virginia Beach, just a couple blocks away from this particular market. And a lot of those properties in that area are already Airbnb. And these are big luxury properties right on the beach. So we're talking 8, 9, 10 bedrooms, 6, 7, 8 bathrooms. And that's the last product that we're going to buy in this particular fund is that big luxury beach property. So those are some of the things that we're doing. We're looking for other opportunities where we can keep our money working for us. And because sitting in a bank, number one, so if you get 4 or 5%, well, that's great compared to a year ago. But the money sitting in the bank, you're not getting appreciation. You're not getting depreciation. You're not getting equity buildup. It's just sitting in the bank, and the bank is using your money to loan out to other people.
When did you start diversifying? Because I've always, in my mind, it's always been Anthony equals apartments.
Yeah.
When did you start diversifying?
So the big diversification would have come in 2004 because we started in 93 just doing single family houses and condos. Then we changed in 2000, diversified in 2004, 2005.
And that was to the apartments?
That was to apartments. So we started adding those. Our last diversification came, or not our last, but our next one came in 2016. That's when one of my students approached me about investing in the hotel down in the country of Belize. So it's actually a Hilton hotel. It's the only Hilton hotel in Belize. And
in the whole country?
In the whole country of Belize, yeah.
Wow.
The only Hilton hotel, yeah. It was the first big name brand one down there too. There was a tiny Ramada near the airport, but this particular one, this was the first big chain between Hilton, Marriott, and a couple of the other ones. This was the first one that was what they call flagged it down there, right? It was a Hilton flag. And so we bought down there. We bought a fourplex down there in 2016. We then bought another one in 2016. So we had 8 units. We liked it so much. My wife came down because, it's a business trip. So both of our wives came down with us on one of our trips to inspect the property because we had to inspect the property. And my wife, for both of our, his wife had already been there before, but it was the first time my wife had been there, and we loved it too. And we knew that they were looking to buy their own townhouse on the complex because the way that we had the investment structured, we would not allow our investors to use it there. So the term is personal use component. There is no personal use component on the units. It was just strictly for rental. Well, so we knew if we wanted to come back down, we couldn't use those units. We had to get our own. So we knew that they were looking to buy something. So we approached them and said, hey, we know you're interested. We're interested. Do you want to split one? And they were all for that. So we bought a 2-bedroom, 2-bath townhouse down there as well.
Do you mind if I ask just what did that cost?
The fourplex was all in. So this is all in. This was the land, the building, the furniture, the fixtures, the shinens. That's a combination of sheets and linens, shinens, linens, glasses, plates, mattresses, right? Everything all in was like $850,000 for the fourplex. Okay. The townhouse was about $440,000.
Okay.
So even though it was one townhouse and half the cost, it's ours.
Yeah.
And it's also a lot bigger and a lot nicer, where the fourplexes are just basically studio units. That's all they are, studio units. This is a 2-bedroom, 2-bathroom. It's like 1,700 square feet. It's got a huge living area downstairs. The bedrooms are upstairs, laundry. All
Sounds like a very comfortable vacation house.
It's a business retreat.
Yes. Sounds like a great business retreat.
So we did that pivot in 2016. And then in about 2019, we did another pivot because, again, because apartments started to slow down for us. We weren't finding deals that made a lot of sense. And we had investors that had money ready to go and didn't want it sitting there. So in 2019, we got an offer to go down to Paraguay and look at this agricultural investment. It was orange grove lots, vegetable greenhouses, strawberry greenhouses. And we flew down to Paraguay right before Christmas in 2019. We spent 3 or 4 days down there, me and my wife and another group of investors. Liked the project, met the guy that was running the project who had been there for 25 years. He's actually of German descent. He's a cattle rancher, but he realized he's a business person, a very successful business person, realized that there was a need for fresh fruits and vegetables to be grown right there in the country of Paraguay, because something like 80 to 85% of all the fruits and vegetables were being imported from the surrounding countries. So the quality wasn't good. They cost a lot because of all the transportation fees.
Yeah.
So all of a sudden he had this brainstorm and started planting orange trees to grow oranges, and then started putting in vegetable greenhouses, which then morphed into additional strawberry greenhouses. So we raised $1.1 million to buy 11 orange grove lots and 2 greenhouses. And then about a year after that, we went back to the Hilton. The sales manager at the Hilton knows me and my partner, Randy. And he said, hey, there's one owner who owns, he'd owned more than 34 units, and he was selling them off one at a time. And he hit him up and he said, hey, instead of selling them all one at a time, would you like to just sell them all as one big package? And he said, yeah, he'd be open to that. So he ran, this guy named David contacted me and Randy and said, hey, I know you guys already got stuff. You're looking for more. Here's what's going on. And we said, great. So we started going back and forth through him to the seller, making offers. And we finally settled on a price of $3 million. And I mentioned earlier about how we had raised $4 million for the project. Well, the $4 million raise was $3 million for the purchase price. And then the other $1 million was for rehab costs, because some of the units were not completed on the inside. They never actually paid to have the insides finished with the furniture and the plates and dishes and all that kind of stuff.
So were they just sitting vacant?
They were just vacant and just empty. There was nothing in them. Yeah, they were doing nothing.
The sin right there.
It absolutely is.
But good meat on the bones for you.
Yeah. So, and then some of them, and then the rest of the $1 million was for reserves, because you've got insurance and there's what they call fees and stuff that you have to pay for them to continue to maintain the property and stuff, even if they're not being rented, and insurance. So we were really happy about that, because we had what we call soft commitments for over $4 million. Actually, it was close to $4.4 million within 2 1.5-hour webinars. So the reason our investors jumped on it as quickly as we did, because as soon as we came to the purchase price of $3 million, we were like, done, because we know the retail value of the properties is $7.2 million. So once they're all done and sold, and that's the idea is out of the 34 new units that we just purchased. So out of the 34, we were going to sell 24, and we'd own then 10 of them free and clear. So we'd still have that cash coming in from those 10 other units, but the investors would have all of their money back in their pocket.
No, that's a great structure.
So yeah, so we jumped on that. The investors jumped on it, raised the money really, really quickly. So that was not really another pivot at that point, but it was another kind of, I guess, a mini pivot, since we were already in the hotel market, but another way to keep our investors diversified.
So if I'm kind of reading between the lines here, you're just really focused on what's going on in the market, where the opportunities are, and you're just kind of following it that way. As, hey, something starts slowing down. Hey, one door starts closing, another door starts opening up.
Correct. There's always something out there, and there's a ton of different ways you can make money in real estate. That's why we got into the short-term rental fund, right? Because again, I saw that apartments weren't turning around as quickly as I would have liked. How can I kind of be in that market? And that's one of the reasons they liked me coming on with them as a partner. Yeah. Because one of the things that we were looking to do is buy smaller multifamily. We do have triplexes and fourplexes, but once you get above 5 units and more, you're now into an apartment complex. So they knew that I had the experience to be able to coach them, if you will, on what the correct value was to buy some of these 6plexes and 10plexes that we're also looking at. So that was the last change that I made, was that, which was about a year and a half, 2 years ago, was deciding that I wanted to get into the short-term rental market as well.
Gotcha. Let me, I want to ask you a personal question here for my own sake. So like, here is kind of my thesis. So like you, like most people, I start off in, single family. I started 11, 12 years ago, and, acquired some properties along the way, and just, rode the appreciation wave, add some value, 1031s, cash out refis, just typical things to grow. Kind of my thesis for last year and this year is I am selling a lot of my single family, 1 unit, 2 units, just, single family stuff, 4 units or less. selling high and then buying low in the commercial assets, like, you know, a multifamily. I like some development deals as well, but in my mind, I've had my most success looking at like long-term trends. I'm really bad at day trading. I'm really bad at making money really quick. I just not good at it. I think that's a very hard skill for people to acquire. I don't have it, but like, hey, if you can see a big giant trend, it's a lot easier to make money and just follow that trend.
Yep. So
my mental mind says I've been selling high because I don't think we're going to see any price crashes in residential. I mean, Denver just came out. We're like 5% year-over-year appreciation. I think it'll be like steady Eddie, probably below average appreciation overall, but then buying low on the commercial side.
Yep.
I'd be curious as to like your perspective on there, because this was a new flip for me. I've always just kind of like rode that residential trend. Then I started getting the multifamily a couple of years ago. Same thing, just would trade up. And then I'm like, oh, it's all in real estate, but I can sell high in this asset class and then buy low over here. And that's been a new shift for me.
Yep.
But I'm curious from someone from your perspective and your experience, like, is that good idea, great idea, bad idea?
No, it's a fantastic idea.
Okay.
You can absolutely shift products. So one of the big opportunities that you asked about earlier right now is with office buildings. Office buildings started crashing during the pandemic.
Yes.
So that was 3 years ago, almost 4 years ago now. Well, it really hit, right? 3 to 4 years ago when it really started to hurt businesses. And so right now, one of the big things, if you want to buy something low, would be to sell some of those properties and start buying office space.
I'm terrified of office, though. Are you buying office?
We are looking at it, absolutely.
Really?
Yeah, absolutely. There's a couple reasons that we're looking at it. And one of the reasons is keeping it at office space. If you can buy it for pennies on the dollar, and this happened because you asked earlier about those market cycles. So bring it full loop, right? One of the first market cycles I went through when I moved here to Denver in 1984 was shortly thereafter. You had the crash that was between about 1986 and 1990. Well, the biggest crash in the Denver market was the office space. There was office buildings both in downtown Denver and the Denver Tech Center area where they were pretty much vacant. There were a lot of oil companies that shut up shop here in Denver and moved all their employees, whoever they wanted to take back with them, back to Texas. And so there were hundreds of thousands of square feet of office space that was completely vacant. There were people that were going in and they were buying up these offices or subleasing the office space. They'd basically lease it for like $1 a square foot per year and then turn around and lease it to somebody else for like $2 a square foot per year. And they were making money off of that.
It's a great arbitrage.
There was a huge opportunity there. And the people that actually bought the buildings did even better because think about it now. Do we need more office space right now in Denver?
No.
We don't. But is there more office space now than there was in 1986?
Of course.
Absolutely. It's probably doubled or tripled since I moved here. So what does that mean? That means that even though the market was in really bad shape back in 87, 88, and there were hundreds of thousands of square feet of vacant office space, the people that took action and bought it up because they saw the pendulum. There's all kinds of pendulums when it comes to different investing. Right now, the office market pendulum is way off to one side. Well, eventually what it's going to do is it is going to swing back. And it's going to swing back to the point where there's not enough office space. And now they're going to start building even more office buildings to fill up the office space that's needed. Now, that's assuming there isn't some big pandemic that actually does wipe out billions of people or a war that wipes out billions of people off the planet. But ultimately, everything goes through peaks and valleys and swings.
Yeah.
So if you're starting to buy up that office space now, when everybody's has to sell because they're dying, or you're buying it from a bank that's already foreclosed on the property and buying it for pennies on the dollar, give it a few years and it's going to come back and it's going to be super strong. And you're going to be very glad that you did that.
Because I agree for the macro. My biggest hesitation is just how long is that recovery period? Mm-hmm. I don't know office space, so that's if I don't know it, I don't invest in it. Is part of my mantras as well.
Totally get it. That's a great question that you and everybody else should be asking themselves. Absolutely.
Yeah. So so are you're actively looking at office spaces, right? And
yes.
Not for conversions, but just for buy and wait for the pendulum to swing back.
Correct.
What's your guesstimate for like the time frame?
My guesstimate would probably be 5 to 10 years.
Okay. So you're buying stuff today where the current tenants in place can pay for it.
Correct.
Until it rebounds.
Right. Correct. So it has to still work today.
Yeah.
Now, some of these buildings that we're looking at are completely vacant. Where's the cash flow there? There's no cash flow. That's called cash go. But if you can, right, because you still have to pay for the maintenance, you still have to pay for the taxes, you still have to pay for the insurance. But if you can get it at a good deal, and because you're getting it at such a good deal, you can go basically poach some people, if you've got a good broker, poach people from other properties and say, hey, you're paying $15 a square foot there, you can pay $5 a square foot over here.
Are you looking in Denver at office buildings or other markets?
We'll look wherever it makes sense. Denver is actually a tougher market because, as you pointed out, they're still selling houses like crazy and the value of houses is going up, which means there isn't really a lot of distress. There's some distress in Denver, but not as much as other markets when it comes to office space.
Yeah.
So one of the opportunities is buying office space and keeping it as office space and waiting for that pendulum to swing back. And if you have companies that can go into those spaces at less money on the square foot, you're going to be okay. The other potential opportunity, as you mentioned earlier about converting, there's a lot of people around the country that are converting these underused office spaces to affordable housing because you need a lot more housing, especially with what's going on in the market, with all the immigrants coming in, with what's going on in the market and more homeless people. There is a need for less expensive housing. The potential downside, though, with that particular avenue is that a lot of people go out and they buy the property first thinking they're just going to convert it, and they haven't done all of their homework to know what goes into the actual conversion. And a couple of the big things that people run into because they're not aware of it is things like water. And you think, well, water, what do you mean water? Well, if you think about an office building, most office buildings, let's say you've got a 10, 20 story office building. Generally, there's only 2 to 4 restrooms on each floor. Right? They're not plumbing for multiple kitchens and multiple bathrooms. They're plumbing for one men's bathroom and one woman's bathroom.
Yep.
So you have to have the plumbing that now, so let's say you take a floor and turn a floor into 8 apartments. Well, now you've got at least a kitchen and a bathroom. So that's 2 extra water lines, plus the sewer lines. Oh, plus the toilet, right? Plus the shower, plus the sinks. Right? If you put it in a dishwasher, right, it all starts adding up with all this extra water that you need and the water lines. And if you don't have enough, this may sound kind of weird, but if you don't have enough ceiling space because you bought an older building, where are you going to put the sewer lines? Where are you going to put the extra water lines? Right? They have to be up in the ceiling. They have to be run down walls with hopefully good enough insulation so you can't hear people above you flushing the toilet or taking a shower. And if you've been at a hotel, you've probably heard that in some of these less expensive hotels where you can hear the water running and that kind of stuff, and you might get used to it, but you have to have room for that. If it was an office building, most of the time you do have enough power, because even if they don't have walls up, right, because that's the other thing you have to do. You have to come in and you have to put up all these walls to separate all of these units out into viable apartment setup, whether they're 1 bedroom, 2 bedroom, 3 bedroom, however you're going to construct it. So you have to put up all these extra walls and then run the electrical to those, where in an office buildings, at least newer office buildings, they have the floors that you can just pop up, right? And the wires run through it. It's like a raised floor. Mm-hmm. So you have to have enough room between the floor and the ceiling to be able to run your electric, because generally you're going to take out the raised floor if you're making an apartment. You take out the raised floor and then you're just on concrete. Well, where's the electric going to run? Well, it's going to run through the ceiling with the water pipes and the sewer pipes. So again, if you don't have enough spacing in the roof, that could be a problem. One other additional thing that a lot of people don't think about is some of these office buildings in downtown sections, cities that are now vacant. Why are they vacant and where did the jobs go? So the other thing to look at is if you put in all this housing, well, the jobs just left. So where are the people going to work that are going to move into that particular property? Are there enough jobs downtown, enough people that want to live downtown that they're willing to fill up that space? Or is it just going to be people that are homeless or immigrants that have no income, and now all of your income is coming from the city or the county or the state, because you're providing some type of a shelter as opposed to a true apartment complex, if that makes sense.
No, that makes sense. And I'm glad you brought up the conversions because, I mean, I got excited about a couple of years ago and I started looking into them, and I had a couple investors, and they were, the more successful, smarter people than me, the people I'm going to be around and investing with. And they started looking at doing apartment conversions. And every single one came back and said, yeah, they outlined your issues. Some other ones said, yeah, just the numbers don't make sense. Most of these buildings you would basically have to just knock over and build up, and the numbers don't work.
Yep.
So I've not known anyone that's done an apartment conversion in my personal network. Have you guys done a deal, or are you finding good deals in there? Because like I said, my investor friends looked, and it was just like, man, the juice isn't worth the squeeze.
Yeah. Yeah, no, we're running into the same situation. We've looked at a few of them, and it hasn't been cost effective. We looked at one a couple years ago down in El Paso, and just like you said, it would make more sense to knock the building down, and build something brand new than trying to convert an existing office space into some type of housing, like an apartment complex. Now, it does work though. I know a very big developer up out of Canada that has been doing that. But he says out of all the buildings that he's looking at, only about 10% of the buildings he looks at will actually work, where the numbers will work. That's
what I've heard other people, 8 to 10% of, like, on average, that's the most office buildings can convert to apartments. So maybe 1/10. Awesome. Well, Anthony, I know you've been very generous with your time. I also know you and your wife are about to go out and head on another trip as well. So you've got some more fun stuff to move on to, but thank you so much for coming on here. This has been a pleasure for me. Where is a good website or a good way for people can connect with you to learn from you, get to know you more? Where's a good place?
Well, our website is successclasses.com. So that's plural, successclasses.com. They can also reach me on email at anthony@successclasses.com, anthony@successclasses.com.
Great. And we'll put that in the show notes as well. And of course, I'm always happy to connect people. One last question for you, Anthony. This was my favorite questions I haven't asked in a while.
Uh-oh.
Since you've been a veteran for so long, what would you consider like your top 1 or 2 superpowers when it comes to like investing? You've had a great career. You've seen good, you've seen bad. You've coached a lot of people. What are your personal superpowers? Like what is your superpower when it comes to investing?
I'd say twofold. One is analyzing deals. I've been doing it long enough that I can look at deals. My software is actually called the Quick Analysis Software, because I can go through a deal in 15 to 30 minutes and figure out whether or not it's going to make sense and whether or not I even want to put in another offer or put in an offer. So that's number one. The second part of my superpower, I've been told by multiple people that I make difficult topics easy to understand.
Yes.
And so that's one of the reasons I continue to teach, because I get a lot of great feedback from the people that do come to the classes. Even people that have actually bought apartments in the past, they come up. Matter of fact, I had one guy years ago that was sitting in the front row, and I thought he was pissed off. I thought he was like, I was full of, because he was sitting there with his arms crossed. And every once in a while I'd say something, I'd look over, he'd start shaking his head. He looked really pissed off. And I'm thinking, okay, but he's still here after 2 days. So it was either the night of the second day of the class or the third night. And I just happened to ask him, I said, well, how's it going? What do you think of the class? He goes, oh, the class is great. And he was really excited. It wasn't fake or anything. Like, yeah, it's really great. And so I asked him, I said, well, every once in a while I look over at you and you seem really pissed off. Like, my ego, because I had just started teaching. Yeah. This was like in the mid to late 2000s. And I said, from an ego perspective, I'm thinking this guy thinks I'm full of what and what's going on. He's like, oh no, I'm pissed at myself. Every time you tell me something and I'd start, getting really mad, I'd get this mad look on my face and start shaking my head. It's because it was another thing that I didn't do because I didn't know what I didn't know. And you were reminding me of another thing that I missed. And that's why he was basically pissed at himself for missing some of these things that I was teaching him. And he's just like, I wish I had come to this class before I started buying properties, because I would have been a lot further along. It's like, so that was good to hear. And again, I've had multiple people say that I can take difficult topics and make them easier for people to understand and without all the mumbo jumbo.
That is definitely a superpower.
Yeah.
Awesome. Anthony, thank you so much again. This has been a pleasure, and I look forward to connect with you again soon and hopefully doing more podcasts and maybe some deals in the future together.
Yeah. Awesome. It was fun. I'd love to do another one. And yeah, if we have deals, let's talk.
Thanks so much. Everyone, if you got any questions, reach out to me. Of course, get Anthony's details. And we'll see you next week on next week's episode. Bye, everyone.